So that was another one. The third one obviously was the income tax changes in the law, which again makes it a bit inconvenient for people who won a case in a court to go back again to the tax authorities if they have been. So there are a few things which are negatives there. The unsaid things that could have done is, and why we coming from that angle is that the world is today uh, fighting to get foreign flows, right? And you've seen that. I mean, India has been a big sufferer of this, in the sense that we've seen our rupee getting hit so badly, probably with the worst performing currency in the world today, apart from an Indonesia, which is going off the developed market, I mean, emerging market angle it totally, and they're going to frontier markets in MSCI and stuff like that. We don't want to be there, right? So that's why we are probably the worst performing currency in a market of substance as such. We're the worst performing market year to date. The worst, actually. There's no one else who's beating us. Again, Indonesia, if you compare, he's the only guy who's beating us in terms of being more worse than us. But the fact is, we don't want to go down that route, so that's why we won't even compare ourselves to Indonesia. So anyway, so that's why we were looking at some kind of incentive for FPIs to come back in. As I've been saying all along, today they don't have any incentive. If you're looking at by the way, this GDP, I mean the real GDP growth estimated in this budget for FY27 has been, sorry, the nominal GDP growth has been estimated at 10%. That won't excite anybody anyways, but if you look at the fact that even on a last 25-year basis, India's GDP, sorry, not the GDP, the index growth, the index growth, as in the market has returned roughly around some 12, 13 odd percent in the last 25 years as such. If you remove the currency depreciation and the fact that you pay a long-term capital gains, which is, by the way, India is the only country in the world which applies long-term capital gains, or rather capital gains on foreign flows. No other country does that. If you bring money from abroad, I mean, if I invest in the US, I'm not charged any taxes out there. I'm charged taxes in my country of residence and not in the country where I invest as a foreigner. So if you remove all that, the return in dollar terms turns out to be 7 odd percent. I don't think that's exciting anybody, right? So that's why we are hoping that at least they'll take away the capital gains angle for FPIs, forget FPIs for all of us as such, and let us be on the long-term capital gains. Let the short term remain there. You can increase the taxes on the short term if you want, but the long term should have been done away with. And probably to compensate for that, you could have had a higher STT, but they heard one leg of the argument and they didn't hear the other leg, which is increase the STT, and forgot about this. So anyway, so let's come to the budget itself. So I think that was the more disappointing part than anything else. The unsaid things, as I said, were more disappointing than the ones which were said. And anyway, the budget exercise, as I said, that it's always a exercise of boredom. One must have realized it. I mean, in 2 hours, the FM that she delivered the budget, there wasn't much of substance being said in that budget as such. But let's understand the constraints that we are coming from. We need to have some fiscal, I think, security going forward. If you're looking at employment, you need to have a very tight balance sheet as such. And that's where this government is coming from. And that's why they've kept their deficit figure. Fortunately, by the way, they didn't stick to the flight path with their already stated of 4.2%, and they kept the fiscal deficit at 4.3. Basically, the gross debt to GDP, which was at 56%, didn't come down to 55. That is what was planned. It came down to 55.6%. By the way, let me again highlight to every one of you who joined us is that I'm not an economist. Okay, so I'll just reel off some numbers and then probably I'll look at the market implications, impact as such. So that is where where they're coming from. The borrowings that they've undertaken, I mean, this time around from the market is around 2.2 lakh crores. I think that is a bit of a problem because I don't think that kind of a borrowing can be absorbed. This plus the state borrowing also will be undertaken here. So basically, that will be huge if that happens. But I get a feeling that they've been very conservative in providing for the reserves coming from the RBI. The surplus is being accounted for RBI. And why I'm saying so is that RBI is sloshed, has a lot of uh, dollar reserves as well as gold deposits lying with them, right? And as a result, that itself should throw up massive surpluses. So that 2.5 lakh crore looks very, very less as compared to that. So maybe you'll get another 50,000 crores extra from RBI. So maybe that will reduce the borrowings from the this thing. So I think that is how the maths has been worked out. They've been very conservative, I believe, in assuming a 10% GDP growth, normal GDP growth. I think it'll be much higher than that. But anyway, let's assume even if it's 10%, still then the tax collections at 7% and all is considered very, very marginal as compared to what we did last year. Even in the bad year, we've managed to do more than that as such. My feel is that probably we'll overshoot in this basis. And as a result, this probably budget was laying the foundation for the future. Nothing much can be said about 27. But having said all this, let me talk about the specific sectors. Now, I've taken down certain notes. So probably I'll be going on referring to those notes as I speak. But let's start with the financials bit. I think the STT and FNO was basically a very negative thing going forward. I think that will reduce not only the turnover in the market, the arbitrage funds will become less lucrative as such. So that's where the problem arises. And anyway, so that's I hope some semblance comes and probably may see some reversal if at all they see some kind of argument out here. But anyway, the FM was very clear that she's put it on FNO because she thinks it's a satta bazaar and pure gambling is happening and there's no hedging happening. But anyway, so that's their way of thinking. So let's hope that thinking changes at some point in time, but let's see. But yeah, the other big impact in the financial space was PFC REC, the restructuring. Hopefully, that will lead to reduction in duplication of work that both these arms are doing. Maybe they'll be merging these two. That's what my feeling is. Bring down the cost of funding for both of them and free up capital as such. So that's with improved leverage, obviously, that will free up the capital. So I think that's where the whole of this the financial space is covered with that. They allowed AMCs and PMS and wealth managers to get money from overseas, but I think that was already on the cards. I think that helped in a way. The second big thing that happened was probably the defense space, in the industrial space. I think defense was a big winner out here, no doubt about that. Even on a like-to-like basis, the capital goods within defense, I mean, basically the actual equipment which you purchase in defense saw a growth of almost 22% on budget estimates and 19% on RE to be revised estimates to budget estimates for next year. That is a huge one because this is the first time I've seen equipment rather as 26% or 27% of the overall numbers for defense. This has happened after probably decades that India has done that. I think basically it was forced upon us the way our neighbors have been behaving. It was forced upon us, and I think it's a very good move for not only the domestic place but also for our army as such to modernize and stuff like that. So that should be good as such. Railways saw a 10% growth and so on and so forth. So I don't see much of this thing out here. But the fact is that all these things are proving to the fact that the government has been pretty open to doing Capex when the private sector is backed off. I think this is a very big positive that has to be taken away from this. 12.2 lakh crores is what they've kept aside as total overall Capex within this budget. A bulk of it is going to defense, railways, and roads and transport and all that, which is supposed to be the good part because this is what you want to spend on to get job creation going as such. I think that's the good part out here. So this 12.2 comes on the back of a 11 lakh crores. So if you guys remember, 11 lakh crores was actually the provisioning was 11.2, but the revised estimates are showing as 11 lakh crores because our feel is that the government is running out of roads to make as such. That's why a big portion of this Capex, around 2 lakh odd crores, is being shown as advances being given to states for their Capexes. I think that's the good part. So ultimately, the government has realized that, look, I can't do much more than this. Let me pass on to the states, let them do their development. And obviously, these are fraught with caveats or such. The good part was that the useless expenditure, the expenditure which does not earn much, like subsidies and all, were very controlled. The rural expenditure had gone up, but most of it was because of the new scheme, the RG Ram, R Ram G or something, G Ram G, sorry, G Ram G scheme, which is taken up the bulk of that spend as such. So that's what happened out here. Otherwise, the another big thing being talked about was on pharma, but pharma was more of lip service because pharma, fortunately for us, our private sector is pretty strong out here. They don't need much of support. So even the numbers that were talked about were over 5 years and 10 years, like 10,000 crores to be spent on a biopharma Shakti, but that 10,000 was over 5 years. So 2,000 crores is not going to make any difference as such. Tourism, medical value tourism, setting up hubs in various states and all that. Again, that is a long term story. So, all these things will plan out on the long term. But in terms of IT, I think there was a knee jerk reaction yesterday on IT. I don't think IT is going to be that big a beneficiary. The good part was obviously that the Capex part of the data centers. If you look at a 1 gigawatt Capex center, 1 gigawatt kind of a data center, the Capex involved is roughly around $25 billion, right? If you take the infra and the interiors of that, in the sense the hardware and stuff like that, the wiring and all that, of this $25 billion, the pure basic, the raw infra that is needed, which is the structure and the foundation and stuff like that, and uh, the power inputs and all that, it's around $5 billion, right? That is the kind of inflows we're gonna see here. So basically, it's each gigawatt of a data center will require around $5 billion of pure infra. Rest all will be, I think, bulk of the CBUs and all will be imported. But the fact is that this 5 billion will be undertaken here. So India is looking at something like 40 gigawatt kind of data centers over the next 4 5 years. That's like a massive. We're talking about roughly around 200 odd $1 billion of $1 billion of capex going in if that happens as such. And by the way, in terms of power, India has got enough. We're talking about adding around 40 odd gigawatts of power every year in terms of renewable energy, which is supposed to be very positive as such. So that's what's going to happen out here. IT per se will not benefit out of it, obviously, because it's like a rental model that you're doing. You'll, like TCS, what they did, they announced a data center, but that's going to be pure rental model, which is going to work out. But the fact is that you'll see a lot of inflows of, by the way, the tax holiday being given for data centers till 47. I don't think that's the exciting part. The exciting part is that a Google or a Meta will come to India to not only because they are looking at diversification in terms of their data centers and cheap power, which is the case with India, but they're also looking at being close to a market which is expanding. By the way, India is the largest consumer of LLMs today as such. Yeah, they've surpassed even the US as such. So I think they want to be close to a market which is doing this and learn from us. We generate a lot of data, so they learn from us from the data that we generate. But AI is ultimately about learning, right? And that's what's going to happen out here. So I think that's a big one. And the big thing which went unnoticed for IT was probably for the global capability centers, the GCCs, if you will. The GCCs till today, there was an assumed tax being applied on these GCCs because they supply a lot of services to their parents abroad, right? And normally these IT guys used to come and on their whims and fancies decide what kind of profit their parent is making and which should be taxable in India. I think the presently today, I mean, the way they have the new the announcement has come is that there's an assumed tax which is to be paid by a GCC, which is around 15.5% of his revenues, not tax. 15.5% is assumed to be the profit on the revenues of the GCC, and you pay a tax on that particular revenue as such. I think that simplifies quite a bit of the structure going forward. So that's another big positive that one saw in this budget as such. In terms of telecom, there was not much to talk about. Again, 4G rollouts and stuff like that. One thing that happened for the mid-cap space would be probably the way the PLI scheme has been restructured, right? Earlier, the PLI was being paid out to, rather, by the way, the PLI scheme has been increased from 22,000 crores to 40,000 crores, but a bulk of it has been, obviously, has gone to auto space, which I think will, the foreign parties will benefit more out of this than us. But a fair portion has gone to our EMS players, electronic manufacturing services players. But here, what they've done is, instead of giving it to pure assemblers like Dixon, they've now decided that they're going to cut the assembly part, and the manufacturing part is going to get a bigger one. And that is why you saw yesterday Dixon reacting and the likes of Sirma and all going up. That's mainly because they moved away from an assembly player to a manufacturing player, which is the kind of, say, Amber and Umber rather, and Sirma and all these guys. I think that's what's happened out here. As such, e-commerce, they're formalizing, internet and all that, they're formalizing by doing more of this. Nothing much beyond that. I think that was the bulk of it on the front of the budget as such. So I'll stop here and I'll let you ask me any further questions. Do you think I think I've covered bulk of the budget out here. Basically, as I said, was supposed to be a boring exercise, but it turned out to be a bit exciting in the wrong side because of certain omissions which are there and certain presences which were not asked for came about. The whole indicator being given was that look, we're not worried about the markets. We worried about the long-term growth of our country and not the short-term capital that is needed by this country as such in terms of flows from outside. I think that was the bigger picture, which was being rather the short picture was given out, and I think the market interpreted that accordingly, and that was the reaction which came by. So anyway, the fact is, the long and short of this, the budget is out of the way. Let's not even look at the budget. As I always say that normally the budgets are supposed to be non-events in terms of markets, and let's take it that way. And from here on, let's look at what the earnings growth looks like, what the markets look like, what the global markets are talking about, how India is panning out to be, and stuff like that. So let's leave it here.
So thank you, Dinshaw, for that an update. One question on the capex. If you see, from 2021 to now, right? I think 12 lakh crores, 12.2 lakh crores. I think that's the estimated number, which moved from, I think, 4 odd lakh crores from, so almost three times, right? 3x kind of capex, which might, from last year to this year, it might look very small number. It might look but if you look at a significant term of last 5 years, you will see that it is almost 3x the capex which is gone up. So, so do you think that like we have seen years and we've been talking about that capex led growth has not helped us. I mean, in the election year. But do you think that last year and the follow through year this year, the kind of capex which is being planned in, be it in defense or be it in railways or infrastructure overall, will help the overall economic growth and thereby will result in the corporate earning growth?
So as I said, Devi, see, if you go back a bit in history, I mean, if you look at say 15, 16, right, the capex was just 2.5 lakh crores. The 4 lakh crore that you mentioned was in 2021. That was the
Yeah,
kind of capex that one saw there. So
yeah,
it's been a very compounding growth for capex. Okay.
yes,
And the compounding, and why I'm mentioning 2015, 16 is that was the first year of the budget of the present government, right? I mean, the
yeah,
present government as in the BJP government, the
BJP government,
NDA,
yes,
yeah.
yes,
So that way they've done a phenomenal job. I mean, it's like almost 4x of what we were at that point in time
Yeah.
to where we are today. But also understand that this is annual capexes that we undertaking, right? India can only absorb that much of capex, which
Yes.
I somehow I believe that that is because China does, I think, what 10% of India's capacity they had in power every month, right? So you can imagine that in a year they will add the same amount of power capacity that India has. So we have enough to play with. But I think the government is being a bit conservative because they don't want to go over the way that China has gone. Obviously, they need a lot of power more than us because the side of the GDP also is 5x of ours as such. So that's not the thing. But the fact is that we can do with capex. But I think the government today is trying to push the states to do the capex more than us. So that out of the 12 lakh crores, 12.2 lakh crores, 2 lakh crores is kept aside for the states.
Estates. Yeah.
Yeah, for their capex. So basically, from the 2.5 which I mentioned was purely the central government's thrust. That 4 lakh crores again was a central government thrust. I think around 20-30,000 was given to the states at that point in time. But
Yeah.
the fact is that even from 2.5, they've increased it to 10 lakh crores, which is like 4 times, 4x's. And the states have been pushed to do their capex. So if that happens, if that goes ahead, and this, by the way, these capexes even last year was came back to the center because the state didn't do as much capex as was needed because there's always caveats in this. You cannot give grants and all when you give them for capexes. You have to have certain milestone that you're supposed to meet. So if that happens, I have no doubt in my mind that India needs this kind of capex anyways to grow at a very steady pace of, I mean, if you're talking about real GDP, then we're talking about 6.5% kind of growth. But unfortunately, you need far greater capex out here. If you're looking at growth of say 7.5, 8%, right? So for this 6.5 odd percent growth, this is fine and okay with. But if you're gonna grow faster, you need more capex out here,
You need
right?
more capex.
Unfortunately, the state needs to push more than the center because only center can do that much. And again, unfortunately, the state controls the land reforms, the labor reforms are all state subjects, right? So that's why the government is trying to push the states to do it so that they can grow faster than this. A center can only do that much and nothing beyond that. That's so that way.
So I would, before, I take up the next question, which I have, on behalf of the participants, I would request participants to type in their questions in the chat box, which we will take it up in some time. Dinshaw, in the budget, I think there were two more things. While STT has been, at margin very negative, for the, sentiment, right? But to improve the flows, foreign flows rather. I think there were two more points which were mentioned. One was the PRIOs, in terms of extending their participation. I mean, bringing them into the FPI ambit. And second was also improving the FEMA. I think modification of FEMA, which has been talked about, which I think will follow through in some days. So what's your take on that? Did you, do you think that that would, sort of add to a better compliance in terms of the FII flows coming in, would improve some bit of sentiments there?
So as I said, that look, the problem is the double taxation that comes through in what we're doing today, right? And as I said, that for the FIs to get excited once again, you have to show higher growth, right? Which I have no doubt in my mind that that'll come through. But after being hurt so badly, look at US. I mean, in dollar terms, if you're getting growths of 9% or in dollar terms in the US, I'm talking about the last 5, 6 years, right? 10 years or so, rather not even 5, 6 years. If you're getting 9% kind of dollar growth, why would any dollar investor come to an emerging market like India? Why take that risk, right? You have to get that growth for him to excite
Growth
him.
in
You have
return,
to
yeah.
give them that 4, 5% extra, which we used to do earlier. But unfortunately, we've lagged because of various things. I mean, I've discussed this earlier, so I won't even waste time on this present crowd discussing it again. So if the growth comes back, they will come back. But you know that the growth takes a while to come back, right? Because most of these are the large cap players. Even this quarter, the large cap universe hasn't done much, and I'll share those numbers with you when I come to
Yeah.
that part of the query because I've done my work on the results which have been declared thus far. Uh, why would they get excited with that? So you had to give them some incentive to come back, right? What you mentioned was also fine. I mean, things are okay, but the fact is that once they come here, they pay a capital gains tax. They are mostly from tax-free regions, or even if they're from taxable regions, we cannot issue them a certificate saying that if you've deducted this much tax on the behalf of government of India, which you can take a rebate from in your country of origin, right? If I can't do that, they will not be able to claim back that tax that they've already paid. So they'll pay a further tax in their country of origin, and that's how the things will work out. So these are small steps, but one big step could have been whatever I mentioned earlier. So maybe they'll come, but not in a rush. It'll be a trickle
Yeah, but
before they come back in.
this government has been functioning largely outside the budget, events, right? I mean, in fact, GST cut came along later, 6 months, 4 months after the budget and all. So I think, we hope for something which can come. But you mentioned about the written, paradox in terms of, that they don't see enough written Dinshaw. But do you think that mid caps will also not excite them, because see, ultimately we've been underperforming, right? And if you see, the these are cash flow assets, right? Equities are generally cash flow assets, and we have very recently seen, if you look at the commodities, which is the value storage assets, which is gold and silver, you see the kind of run up they have seen, and those were purely based on sentiment. So if the earning growth improves in India, and which we've been talking about that it should improve as we go ahead, will you don't see that there'll be enough excitement on the mid cap and small cap space, or in general for the market?
So, as I said, Devi, I think the excitement is going to be there. There's no doubt about it. By the way, even before I answer that, there's one question on SGBs, sovereign gold bonds. They are retrospectively taxed. Someone asked me whether it's prospective or retrospective. It's retrospectively taxed, so it's going
Yeah.
backtracking on your, which is not that well taken by everybody. By the way, the last I calculated, the losses on the SGBs for the government of India stands at roughly around 1,30,000 crores.
Yeah, because
I think they would
I
have come
think,
off.
yeah,
They would
I
have
think
come
it's
off
it's
already.
yeah, yeah, it will come off with taxing, because they will get some because I think they
I don't think so. Maybe it won't be that much because I don't think the initial buyers sold that much. And anyway, there's been a roll happening. I mean, the guys who bought it in the open market, they've
yeah.
again went and sold it later and stuff like that. So I think it's the same lot playing around. So there won't be that much of
But they have
a.
not done any fresh issuance after 2024, after the gold run has started, right? Because though were
Yeah,
they
but they
have
did not hedge their
invested.
position also. They did not
Yeah,
hedge the
yeah,
position.
exactly. That's
It's an unhedged position which was standing there.
Yeah,
That's why
and there was a
that's why the
liability
loss.
of 2.5% coupon also, plus the gain on the gold, and they never
Right.
expected the gold to run up so
Run up
sharply.
so
And
sharply. So that's why they
they,
didn't hedge
so
the
I think
position. And
it's more of a course correction at their end, which they have done, right? Maybe to cover themselves up. Yes, but it's
right, right.
negative. Yes, obviously.
So anyway, so as I was saying, let's come back to the question that you asked about the mid caps and small caps exciting them. See, they normally go to a active manager for these kind of plays, and
Yeah,
we've seen that happening. I've shared this with you that our long only fund that we started in November of 24 with $20 million of money from one client today is at $280 million. So we've seen
yeah,
huge amount of flows happening out there because those are
yes,
actively managed funds and they like that in India. But mind you, active money is very small portion of money that comes to India. Most of it is tracking MSCI EM index, which is that's where the real big money comes in, and that's where the problem arises because they don't like going to active managers. Big money doesn't like to go to active managers as much as passives as such. So I think that's where the big money is. And unfortunately, that won't get too excited. They look at the bigger picture. They don't look at micros the way we do, the active players do as such. So that way, it'll take a while. As I said, that one big push could have been through this budget. Probably it's an opportunity loss. Probably we'll see it later whenever it comes through as such. So that way. And mind you, even the depth in the market may go down if the FNO space goes off as such in terms of the higher STT if because all said and done the arbitrageurs they provide a lot of depth in
yeah,
volumes for the market as such. If that disappears, it'll be the impact cost is also going to be high in terms of buying and selling. So that way.
One more question, then show on the very hot, metal, which is, silver and gold. 29 January, from 4 lakh, I think 4.2 lakhs. It's now in INR trading at 2.25, or almost, 40 odd percent. Silver is down 25 odd percent was gold. So what's your take on that, on the commodity side? I mean, what are you looking at?
As I had said earlier, also, I remember last time also we had discussed
So
this, and
now
I said
let me rephrase the question. So, silver, gold, or equity?
silver, definitely a no. Definitely a no. But I think it was, and I said that earlier also, that I think it was more of speculation which was happening in silver. And the whole contention was that the argument became, see, earlier the rally was justified in silver, which was a catch up rally to gold. But after that, when silver started doing far more than gold, people came up with arguments that the production is limited because it's not a discovered metal, it's a byproduct, and the fact that the demand for silver will move up thanks to the user industries, right? Now, if I was a user industry and I had to pay a price which was 200% more than what I used to pay earlier, obviously I'll say, look, I don't want silver. I'll do some alternate material. Maybe I'll lose out certain efficiencies in my production, but the fact is that I'll do far better if I far cheaper, and the consumer will be far easier to crack with a cheaper material. So I would look at alternates than silver, right? And I think that's what happened. I mean, silver cracking like that 35% in a day. Mind you, this is not, those are bear kind of corrections. They're not bull corrections as such. Yeah. So that is what I don't think silver is a good bet to play with. Gold, however, again, as I said that, and by the way, the third argument that was given for silver was that it will become a like gold. Central bankers will love to keep silver as a as a reserve as such. Uh, Please understand, storing 20 grams of gold and 1 kg of silver is a different story, because 20 gram was equal to 1 kg at some point in time. You don't want to keep 25%, 20, sorry, 50% more, 50 times more quantity when you can do with 1/50th of the quantity in terms of your reserves. Bankers don't have those kind of spaces to store metals as such. So anyway, so that was a total humbug story. China was buying the silver for their own consumption rather than for storing it in their banks as such. So anyway, so that's what went for a toss. In terms of gold, I think gold still has some kind of a currency value going forward. But frankly, I mean, gold always does a one big step up and then flat lines. I don't know whether in that flat line we've seen a correction in gold also, a reasonable correction in gold, not a massive correction the way silver saw. But I don't know about much about gold. But as I tell all our investors or anyone who cares to ask me that, look, every time you should diversify your bet. So you want to keep some money in gold, you keep it. Don't go overboard on gold. I mean, keep 5-10% if you want, and that's where you play the whole metal space as such. Equities by far will outperform all these guys over a longer term. Unfortunately, it hasn't done. If the last year wasn't there, by the way, for both these metals, equity would have far outperformed any of these spaces over 5 years, 10 years, 15 years, 20 years, and so on and so forth. Because of the last year, equities are now underperforming. But I'm sure, given a period of time, and by the way, I'm talking about the end of last year, and now I think again, equity will definitely outperform silver in any way, I think, over a longer term. But anyway, going forward, I think equities will far outperform uh, both the metals as such. In fact, equities outperform any form of investment given a certain longer period of time as such. So I'm all for equities today.
You're all for equities today and the quarters forward, right, Dinshaw?
Yes, 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 yes,
So,
definitely.
so which pocket of equity you like? I mean, there are
So
questions
okay,
also.
so Devi, I can share some numbers now that you asked me
Yeah,
this question.
yeah.
In fact, one of the questions was on this only, that small cap. Do you think the
Yes,
timing was,
that's,
yeah?
you know,
So let me start off with this. So if you look at the September quarter which went by, and those numbers are audited numbers, so I can very well share those numbers. You look at so basically the whole excitement of why we launched our small cap was that we saw a lot of growth coming back in terms of earnings
Yes.
for the
Yeah.
whole segment, right? Not only small
Yes.
cap, but across segments. And I shared this earlier also during the time of the launch of the small cap also, that because of the fiscal loosening, which was reversal of the fiscal tightening with the government of
Yeah.
India and the RBI had undertaken in the previous years, the loosening started from the end of 24, has resulted in earnings growth coming back, right? And obviously, GST rationalization was a big step towards that. Yeah. In fact, we timed it accordingly. After the GST rationalization is when we started looking at the small cap and saying that we got to launch this at some point in time. Yeah. So anyway, so that was the whole logic. So look at the September quarter. The September quarter gone by, NSE 500, the biggest, the broadest of indices that India has to offer. If one looks at the overall earnings growth, it was just 15%, right? In that particular quarter as such for the NSE 500, sorry. If you were to break it up into the 100 large caps, 150 mid caps, and 250 small caps, the large caps growth was somewhere around 10%, slightly shade lesser than 10%, but rounded off 10%. The mid cap saw growth of 27% in that particular quarter. And the small caps, which is 150 stocks and mid caps, the small cap 250 stocks saw growth of roughly around 37%, right? Now, coming to the current quarter, December quarter, so roughly around NSE 500 out of this is as of September, end of Sunday, not Sunday, I think it will be Saturday. Some 251 companies have reported numbers out of the 500 odd companies. Of the 100 large caps, only 54. By the way, of the 251 companies that have reported numbers, the growth is 7.5% in terms of earnings. Okay, for these 251 companies as such. The 54 large caps which have reported of the 100, the growth rate is just 2% in earnings, just 2%, right? The 78 mid caps out of the 150 which have reported the numbers, the growth rate is 19.5%. Very exciting, right? It's still like late teens, almost 20%. Let's come to the small cap pack of 119 odd companies of the 250 have reported numbers, 119 companies. The growth rate here is, and hold your breath, it's 44.3%. No brainer. For me, it's a no brainer. The small caps are definitely the place you want to be in because this is where the real growth lies. And by the way, these are the guys who are pulling up the overall growth of 7.5% for the whole segment per se. I think that's where the excitement comes from. And as the more and more come back, okay. So one more thing that I want to highlight out here is that normally people assume that whenever a debacle happens, the small caps suffer a lot because they are very, say,
No
very,
more.
very
Yeah. No more.
they're very weak balance sheets and stuff like that, right?
Yeah.
I don't think that's the case anymore because if you were to look at the strength of the balance sheet, which is obviously measured by debt equity, the large
Mm.
caps universe of 100 stocks at the end of September has a debt equity. Unfortunately, I can't calculate the DE right now because I love to see the whole 500 stocks reporting.
Yeah, but
But
in general, they were
September end,
delivered.
the large caps debt equity was 0.51.
Yeah.
The mid cap debt equity was 0.53. The small cap debt equity was 0.35. And it's only been reducing. The debt equity has been
Yes.
coming off
Since
sharply.
COVID, they delivered a lot. Yeah.
Yeah, so that's what the thing is. And fortunately for us, nowadays the small cap universe starts at roughly around a billion point three, billion point four dollars as such. Sorry, ends at $1.4 billion as such. So that's why they are still, I mean, when I started my career, $1 billion company was a massive large cap, right? So that's why I think we've done a great job in doing this. So I have no doubt there's a small cap space which will do the best. And one has seen that even in the terms of volatility, whenever the markets are flattish, the small caps do far better. Even when the markets are rallying, the small caps do better. But when the market falls, obviously they do worse because there's a lot of panic in the system as such. So that's what drives them down per se.
So, from a next 2, 3 year perspectives, while I know the answer doesn't change from December to year, but now with the budget being in picture, the top three, four sectors for next 3 years, Dinshaw.
So, okay, we stick to our
Financials, yeah, obviously
the
one.
BFSI sector by far will do far better. In fact, even in a small cap universe, you'll see a lot of BFSI names. Unfortunately, there are quite a few NBFCs and financials which are there in the small cap space, which are exciting us per se. So I think BFSI will do far better in terms of a universe, basically because this is the space which provides fuel to consumption. It
Yeah.
not only funds the consumption per se, but also funds the back end of the consumption. So I think that space is obviously consumer facing NBFCs and BFSI is what you want to be in. And that's what will continue to go better. Uh, in terms of consumption, again, we are very selective. We like discretionary, but we are staying away from pure discretionary plays. We playing it through derivatives, which is healthcare and hospitality and so on and so forth. The new age tech companies, again, be it in the consumption space or be it in the fintech space or even in the pharma space or auto space, we playing again through those per se the consumption space. Infra plays, we are very, I think, conservative on defense. We have only one play. In terms of capital goods, we got quite a few. But again, wherever the visibility is clear about earnings growth, and mostly they're in the energy sector. So I think that's how we are mixing it up, and I don't think that is going to change over the next 2 3 years going forward. So.
So okay, so financials, good. How do you think the new, so there are two, three things, in fact, in the budget also, which I think long-term positives. How do you think that that would play out? Maybe, the rail corridor, which is, reducing the time between some of the key cities, metros, to by 1 or 2 hours. Obviously it's a long-term project, but then there was a rare earth, then there was a big one which was on the data center part, right? I think while the rail corridors, rare earth would be slightly long-termish kind of a thing, but what's your take on the data center part? I mean,
No,
how
that's what I
is
said.
it?
Very at the very beginning, I said that data centers is what excited me most
Yeah,
because rail and all is all fine. I mean, there
that
we've
will
got
take time. Yeah, you need to
yeah,
find it
but
and
in terms of data centers, it's a very unique environment that will be created, and I think that's a very big niche that India has looked forward to, which is data centers. And I said that 1 gigawatt data center will require something like a 5 billion kind of a capex from our end. The rest 20 odd billion will come via I think imports, basically GBUs and stuff like that, which will be the component part. But my feel is that even if you're talking about 40, 50 gigs of gigawatts of data capacity coming in, we're talking about roughly around 200 to $50 billion of capex, which is the exciting part for us. And that's a massive flow of money also coming in as such. So, and as I said, that I don't think the data centers will be used for storing outside data. I think they'll be mainly used for our consumption in the sense that India is probably the largest consumer of data today, largest consumer of AI today. So all these Metas and Amazons and Googles of the world would be very excited to put up centers out here to learn from us as such, to learn, and because we're gonna be the biggest market, one of the biggest markets in the world as such for AI and all. So that's where the excitement comes from. One guy was asking me about the SGB again, that if he's bought the SGB gold bonds, that is, and before 1st April 26 and will hold them till maturity. Doesn't matter. If you bought them
doesn't
from
matter.
the secondary market and you held it till maturity, you'll still be taxed, right?
Yeah, it'll still
Even
be
now.
taxed.
So that
It's
way.
only for the people who bought initially, right?
Initially. So it's basically they backtracked their whole law as
Yeah,
such. Earlier they were allowing this kind of trades, but I think the government has realized that they've been hit quite a
they've
bit
been
because
hit
of
quite
the
a bit on this. I think
they
it's
want
an
to make some money
expenditure.
on the side, so that way.
Yeah. So, just one information for all the participants. The recording of this call will be available on our YouTube channel of Helios Mutual Fund. So you can actually, it will get uploaded in 3 4 days time. So you can listen into it and take notes if need be later. I think there was a valuation related concern question which has come up on small cap. Dinshaw did explain about it. That I think the growth which we which was the sole reason why we launched small cap. It's unfortunate that last 2 months has been bad, but let's see how it goes from here. But the sole reason of launching small cap, the reasons were that growth coming back is in terms of liquidity, interest, lower interest rates, and the expected growth coming higher than large caps in the small cap space. That was the reason. And I think STT on a standalone basis doesn't change anything else other than some of the ETFs and the high frequency trading guys coming and maybe adjusting their positions because the cost goes up for them, right? Other than that, it's not going to impact the long term trend or the trend basis which we have launched small cap, and we have raised money, and in fact why we've been constructive on small cap and mid cap space, so it doesn't change that way.
Okay, one thing maybe I want to add out here is that small cap, again, if I was to tell you valuation standalone doesn't make sense, you have to understand the underlying growth for which the valuations are being given,
Yeah.
because the P is based not only on earnings but also on the growth of the earnings, right? So as I said, at the time of our launch, if I remember right, and we got to recalculate, I think the numbers can only move up. The earnings growth was the highest. Yeah, it
Expected,
was the
yeah.
highest in the small cap space.
In the small and
The P
mid,
was
both, yeah, upwards of 20%.
mid cap also was high, but mid cap was
Yes.
lower than the small cap space.
Yeah.
But the PEG was the lowest. Price earnings to growth was the lowest in the
30,
small
yes.
cap case, which has only gone lower after this
Low,
kind of growth
yes.
rates that
Yeah,
we are seeing as such. And one
absolutely.
more thing on GCCs, one gentleman has asked about the safe harbor 15.5%, which is being applied today. Earlier, there was no safe harbor. There was no, the calculation was arbitrary based on the assessing officer for income tax. So they had to undergo a lot of litigation. So most of the GCCs just stay out. With this kind of clarification coming in, I think there will be newer GCCs coming in, which is bad news for our IT service guys, because they were hoping that they'll get that business here given the opacity of opaqueness of our tax structure. But with this opening up, the GCCs can come directly and set it up for themselves as that. So
Done. I think we have no more questions, and so we will wait for the next uh, month for the next call, and we hope I think there is one more question which is coming. Okay, I think so. Dinshaw, thank you very much, first of all, for sharing all the valuable insights with us, and also giving comfort to our distribution partners who are part of this call. We'll wait for we'll see how it goes from here. I think there is a RBI policy in a week's time, or 3-4 days time. Recordings, as you've been asking, it will be available in a on our YouTube channel. We make it available every time, so every month's recordings are available on YouTube channel of Helios Mutual Fund. You can go and see our past recordings also
Devi,
there.
one more.
Yeah.
Let's to clarify. Is one gentleman asked, what did I mean by the growth rate? These are growths in the profits of these companies, the pool of companies that I mentioned, and nothing else. Growth in earnings of the same.
Yeah,
So
yeah, yeah. Thank you, everyone, and have a nice evening. And
yeah,
thank you, Dinshaw, for
thank
your
you,
time. Thank you so much.
thank
Bye.
you. Bye. Have a nice day.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.